markets, about 246 billion naira was allotted in 3 federal government bonds auctioned by the Debt Management Office. According to the DMO, original coupon rates of 13.5, 12.5 and 13% will be maintained. Tunde Adama, head of trading at Citibank Nigeria, joins me to discuss this and other activities at the fixed income markets. Tunde, thank you so much. It's a pleasure to have you on the show today. Let's talk about, before going to the actual market action, I want to talk about inflation rates for the month of July. I know that the market always keeps an eye out for that. Over 19.6% also. How is the market processing this, considering where rates are at the moment?
Well, it's sort of been expected. Most of the forecasts already have us going up. Mid-levels expectation was about 19.4, 19.5. So 19.6.
So still within the ballpark.
Yeah, within that ballpark. I think most people have forecasts probably going over 20. We know inflation is high everywhere in the developed world, a lot of developing markets and all. So Nigeria is not unique from that perspective. And so market sort of expected it. So a lot of it is priced into the way people are looking at where interest rates are. And people did expect, those high rates.
But still speaking about rates, the CBN did also recently announce an upward shift in savings rates on savings accounts to 4.2%. Your thoughts on that?
Well, it's been as low as 1.25 for a while now. During the COVID era, central banks sort of brought those rates down as all the yields and interest rates in the market came down. We have inflation at 19.6, like you mentioned, so there are huge negative real interest rates. So it's expected that as central bank continues to increase rates, 2 consecutive MPC meetings where they raised rates, total of 250 basis points, it would feed into all other securities, and both on the deposits and on the lending side as well. So not surprised that they are taking the rates up to 4.2. People who are depositing and keeping their money in savings accounts, because even at 4.2, we are still talking about a 15% or thereabout negative real interest rates. So there's still probably a bit more room there as well.
Yeah, no joy there, as some investors, some customers might say. But what can you tell us in terms of how the market has performed in the last 2 weeks? We've seen, of course, the regular DMO auctions at the market. Talk to us about market liquidity situation. And investors, the playbook at this time, we've seen a gradual, correct me if I'm wrong, that could have changed in the short term. It's like the 90-day, especially investors always keeping an eye on that, the 180-day, the 1-year T-bill notes.
So we're in a rising yield environment, again, because of inflation, and central bank having responded to it and generally responding to it. At the MPC meeting, central bank had mentioned that they're going to keep monetary conditions tight, in line with, the actions that they're taking and to sort of rein in inflation. So we've seen that in the money market. It's somewhat tight money market, and so yields have come up across board. Yesterday, even at the auction, we saw yields, the monthly bond auction, yields go up month on month. The 20-year, for example, the most popular one, yield went up about 25 basis points month on month. At the short end, 2025, it was much more. It was like about 100 basis points, much more. Interest was in the 1 year. In the 20-year, there was very scant interest in the 3 and 10-year papers, and more in 20-year, which suggests that the interest is coming from real money investors, pension funds, asset managers, insurance, and the likes.
But those are the usual suspects in the market with limited options. Where else would they park?
Sometimes banks, sometimes banks are the major players, trying to buy liquidity and all, trying to park their liquidity somewhere and all. But I think as we get to these 14% levels, they are starting to get interested. They've been on the sidelines for a few months now. Last month definitely, but the interest seems to be back at 14%.
But at 14% levels, that has implications for fiscal implications, especially for debt servicing. We know that the DMO for a very long time has had that extra wiggle room in terms of low rates. Many of the instruments are always oversubscribed, obviously because lack of options. But now at 14% levels, what does that mean for the fiscal authorities?
It's something they have to balance out, because there's one thing, and definitely the federal government would like to borrow at much lower levels. And for most of the last 2 years, they've been borrowing at levels that are much lower than historical levels. But with how inflation is happening, how other countries are increasing their interest rates, it's difficult to justify borrowing at those levels. And you see investor apathy. Last month, for example, we saw how they put 225 billion on offer, but they were only able to allot about 120, 130. As inflation increases, as other countries increase, you would find it difficult to maintain your rates at lower levels. So those rates will adjust. Investors will ask for higher levels to buy your paper. And so in a way, it's not a choice thing. It's a case of you need to fund your deficit, and investors want higher levels for it.
Yep. Well, finally, we have about a minute left. Corporate bond market. I had several conversations this year with other analysts about, prospects.
Yeah.
But it appears that, it's looking bleak, by the day for the corporate bond market. What
Well,
are your
last
thoughts on
year
that?
have been great for corporate issuances. When yields were lower on the government side, it was easy for you to borrow at much lower levels. And people who went into it at that time, smart call, funding your needs at that time, it will become a bit more expensive. And so I would expect that there will still be people who will need to borrow. Business has to go on,
Absolutely.
but it's going to be a whole lot more expensive. The last 2 years was a great time, but I think times are changing now.
Well, the holiday's over. A few seconds left. Forecast for the rest of the week. Trading, what should we look out for at the market?
I think it's going to be sideways. There was people who needed to invest their cash went to the bond auction. Market is still a bit tight. And because people still expect yields probably still inch up a bit, so I expect that there'll be moderate activity in the bond market.